Audit of Accounting Estimates and Judgments Part 1 Expected Credit Losses. Ind AS 109 Accounting Estimates and Judgments. What is the ECL approach? Impairment loss recognition and measurement for certain financial assets and other items within the scope of Ind AS 109 is based on the concept called expected credit loss, ECL. Unlike in the concept of incurred loss, the credit risk and resultant loss is identified and recognized promptly and on timely basis in the ECL approach. Under the ECL approach, impairment loss recognition begins from the moment that a financial asset is accounted for, and not at a later stage based on indications, objective evidence of occurrences of losses, which is the case under the incurred loss approach. This ECL approach of Ind AS 109 is based on the international standard IFRS 9, which was introduced to remedy the weaknesses observed during the global financial crisis, 2007-08. ECL applies to all types of financial assets such as loans, advances, investments including less complex items like trade receivables, lease rental receivables, unbilled revenue, contract assets, work in progress, security deposits and bank balances. Also, loan commitments and financial guarantee contracts are subject to these ECL requirements. It is important to appreciate this segmentation and applicable tests in respect of various classes of financial assets. ECL computation is based on unbiased probability-weighted outcomes and range of scenarios, but not on best or worst case scenarios. ECL computations are required to reflect time value of money, i.e., credit loss is measured based on present value of future cash flows. Additionally, ECL has to take into account future forecast economic conditions and is not just based on historical credit loss experience. In case of financial institutions such as non-banking finance companies, NBFCs, in India, ECL being an accounting estimate involving significant expert judgment often requires the use of subject matter experts or professionals. These could be either in-house experts of auditors or management experts 1 and 2 used by the entity preparing the financial statements. What are some of the potential questions that the auditors may expect from the audit committees in respect of ECL under Ind AS 109? Illustrative. Has the auditor considered the changes and trends thereof, in the opening and closing balances, and reversals and charges to P&L on account of ECL? Auditors may need to highlight any unusual movements to the audit committee. Has the auditor verified the appropriateness of ECL recognition and measurement approach adopted by the management for different classes of financial assets, as given above? Has the auditor classified these different classes of financial assets and applied tests specific to each class? E.g., whether the application of simplified approach, provision matrix based on past due bucket, for trade receivables, lease receivables is acceptable? Are there any trade or lease receivables that contain significant financing component which do not qualify for the simplified approach? In case the company has material amount of loans and advances or investments, has the auditor applied adequate procedures to verify the existence of robust internal control systems including credit risk management systems so that management estimates of ECL and related judgments are based on concepts and reliable data that meets the requirements of Ind AS 109? Are there any indicators of increase in credit risk, write-off of bad debts, incidence of substantial trade receivables under dispute, significant percentage of unsecured amounts under litigation, high percentage of receivables at risk, etc., that the auditors wish to highlight? Has the auditor evaluated the management assessment of credit risk or is there complete reliance on management judgment? Has the auditor observed any unusual features in the loans, advances or receivables granted by the company which may need to be considered while evaluating the appropriateness of ECL? Has the auditor observed any loans, advances or receivables from the related parties, including promoters or promoters-related entities? If yes, has the auditor verified the business rationale of such transactions or creditworthiness of such entities? Are there any changes in business terms that had or could have a significant impact on such ECL provisioning? How has the auditor verified the accuracy of those balances? Has the auditor checked the genuineness of the receipt of funds as repayment of these receivables to detect any management bias to falsely report lower balances of loans and receivables, which could result in under-recording of ECL? Has the auditor assessed the recoverability of such outstanding balances and the adequacy of ECL, impairment loss, allowance for these balances? Has the auditor considered the appropriateness of the stratification or disaggregation, aggregation of the data for determining ECL? For instance, Same ECL technique may not necessarily be applied to a class of assets. The underlying asset class may need to be further stratified according to industry, the geographic location, for overseas debtors especially, number of years in business stage in the business life cycle, nature of goods and services provided etc., before ECL is recognized and measured. If recoverability is based on management experts' valuation reports or certificates, has the auditor verified the professional competence, objectivity and independence of that expert, and also the data used by the expert to form his opinion? 3. Has the auditor any such concerns on the management expert, including the one appointed by the Audit Committee U.S. 177 of CA 2013? If loans, advances or receivables to, from promoters or promoters-related entities originate in the books of subsidiaries or associates, has the principal auditor, towards providing assurance, evaluated the sufficiency and adequacy of the work done by the auditor of subsidiaries and the procedures followed by such other auditor? In case the company follows, or is expected to follow, say NBFC or bank, the 3-3-stage classification approach, how did the auditor test the design and operating effectiveness of control mechanism over recognition and measurement of ECL allowance for significant class of financial assets, viz. customer loans, investments? Does the entity's approach for ECL recognition and measurement meet the fundamental principles of the Ind AS 109, i.e., unbiased probability-weighted outcome, time value money, supportable information, data based on historical events, current conditions as well as forecast of future economic conditions? Has the auditor ensured that the category of the financial instruments excluded from the applicability of ECL are as per Ind AS 109? Has the auditor checked whether the entity has adequate subject matter experts such as credit risk experts, recovery specialists, data and IT systems commensurate with the complexity of the credit risk profile of its financial assets and other items subject to ECL requirements? Has the auditor considered the guidance notes of relevant regulators or standard setters for or relevant prudential regulators, e.g. Reserve Bank of India 5 in this area? Has the auditor considered the impact of regulatory developments and policy directions? Basel Committee on Banking Supervision's BCBS guidance note: the auditors, audit committees, board of directors of financial institutions like NBFCs or companies that have adopted sophisticated ECL models the 6th of May find it very useful and relevant to refer to the guidance published by the Basel Committee on Banking Supervision's BCBS guidance note 7 to external auditors and audit committees of banks. This publication of the BCBS, link in footnote below, lays down the 10 expectations of the supervisors from the external auditor of banks and provides potential questions the audit committee may ask the auditors. These expectations and questions are systematically structured into 5 key themes around audit quality and 5 key components of ECL. Key themes of audit quality are: 1. Professional skepticism and management bias. 2. Assessment of risks of material misstatement. 3. Internal control. 4. Use of experts. 5. Audit evidence. Key components of ECL are: 1. Forecasts and forward-looking information. 2. Macroeconomic scenarios and weighting. 3. Models. 4. Significant increase in credit risk criteria. 5. Disclosure. Key standards on auditing SAS that are relevant to accounting estimates and judgments. There are several areas that involve accounting estimates and management judgments. 8. Following key SAS would be of interest to auditors and audit committees. SAW 540, which lays down audit requirements of risk assessment procedures and guidance on nature of accounting estimates, indicators of possible management bias and audit work paper documentation. This SAW expands on how requirements of SAW 31510 and SA 33011 have to be applied in the audit of accounting estimates. SAW 701 deals with the auditor's responsibility to communicate key audit matters, CAM, in the auditor's report. One of the 3 items included as a CAM in this standard relates to areas that involved significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. The auditor is required to report the reason and rationale for considering it as a CAM and how the matter was addressed during the course of the audit. SAW 260, revised, requires the auditor to communicate with those charged with governance about the qualitative aspects of the accounting practices, policies and disclosures. The reason behind such a communication is that the views of the auditor would be particularly relevant to TCWG to discharge their responsibilities for oversight of the financial reporting process.